You're watching Retirement Talk with Eric Kearney, Southwest Florida's retirement television. He's an author, a radio host, a fiduciary, and Southwest Florida's premier investment advisor. Here is Senior Investment Advisor Eric Kearney.
Hey there, Florida. Welcome once again to Retirement Talk with Eric Kearney and Joseph Lanza of Retirement Wealth Advisors. I'm your host, Spike Spangle, and every single week, Eric and Joseph come to you with retirement planning solutions. Fellas, let's get it in unison. How you doing this week?
Hey, Spike.
Spike. Yeah, you both held back on that on purpose. We like to have fun here, folks. Hey, what we're going to be talking about here today is we do want to talk about the volatile markets, what's been going on with both the stock market and what that means to our global portfolios. Even the bond market has been volatile over the last couple of years. And how do we consistently withdraw an income strategy from those portfolios when we're seeing these kinds of up and downs? It's the kind of thing that makes you, as an investor, want to put your head underneath the pillow and go, I don't want to watch what's going on. Get my money out of these risky markets. Eric, let's start with you. Let's talk about our market volatility. Are we going to continue to see this over the next few years?
Yeah, I don't think it's ever going to stop. I mean, you know, it's here to stay. I mean, and people have to understand that you can control it somewhat. And I think that there's a lot of investors out there that don't feel like their volatility is being controlled on a regular basis. There's really not a lot of communication about their portfolio, and there's also not a lot of forecasting. So 5 years ago, we started talking about low interest rates, and eventually they're going to come up. And when they do come up, it's going to wreak havoc in the fixed income world, and boy, did it.
Yeah.
So now we take a look at a 60-40 portfolio, and we realize maybe a 60-40 portfolio really isn't for everyone. Because if you have that 40% of fixed income, but fixed income is getting thrashed by inflation and rising interest rates, now all of a sudden that's not a good place to be. It's actually one of the safest places to lose money. And so we've got to be aware of the volatility, but when there's volatility somewhere, where else can we go to create solace and calm in that portfolio?
That's what we were talking about, is that last year alone, there was nowhere to run to, nowhere to hide, right? Interest rates were going up, and then as the bond values were coming down, people then were getting spooked in the investment markets, right, which brought those down as well. So a combination of the two brought your portfolios down. Near 2008 values, it was 20, 25, 30%, depending on your exposure. Right. So, Joseph, how do you feel about talking with your clients about market volatility? So you set up the plan. They know the income stream. Did you have current clients calling you worried about what was going on last year, or were they more calm?
I mean, when you have a financial plan, that calms your nerves a bit, right? Because you're seeing your financial plan, you can log in. And when you have a living and breathing plan, meaning it's actually pulling your investment data from your accounts and factoring that into the current volatile scenario, well, that's going to calm your nerves a lot. And it's going to keep you from making those irrational decisions. Because if you don't have a plan and you're trying to go through retirement, you know, everybody likes to talk about average rates of return, but a lot of people fail to talk about the volatility in each of those years. And when you're pulling money out, you have sequence of returns risk, which means depending on when you pull that money out, if it's a down year, if it's an up year, it can drastically affect that end value of that account. So if you're not planning for those volatile scenarios, or you don't have an updated live financial plan, then I can see where a lot of people are going to want to make those irrational decisions. And like you said, it's going to make you want to put your head under the pillow. You don't know what to do anymore.
Eric, what about folks who come into you and say, I don't want to be part of the volatile markets anymore. I'm tired of this. Get my money out of there. We can move over to safer CDs, or even what are called MYGAs, short-term annuity rate. You know, get those 4 and 5%. Get me out of there. But we could be in retirement for 25, 30, 35 years. Do you have to talk people back into the market, or do you say, no, you're right, we can get out of here with the market volatility?
I think what we have to do is we really have to see what their needs are first, you know, because so many people are so concentrated on what are we going to invest in? I don't know. What are you trying to accomplish first? Right. And unfortunately, there's a lot of advisory firms that only want to put you into products or investments without even considering your income needs. And so what we're doing is, again, we're putting people through a process. And I think that people really do appreciate going through a process. How many times have we heard, I've never seen this before. No one's talked to me about this. I've never had an income plan. So there's a lot of times where we're putting people through a process. It's a very correlated process because it's based on what you are trying to accomplish. There's not a lot of people that have that out there. And so again, I'm not trying to talk you in or out of anything. I'm trying to find you something that's appropriate. But you know, when it comes to volatility, you can tell that people do not want the volatility. In 2022, there were annuity sales of over $380 billion, and that's up 21% from 2021. So you're finding that people want some kind of guaranteed income that is aside from the stock market. They don't want the volatility anymore. Then you have some people that say, I don't want to have anything to do with an annuity. And then all of a sudden you have the hybrid people in the middle that say, look, we want some stock market exposure, bond exposure, and also some annuity exposure. We want to diversify our income so that when the markets do turn down, I can actually turn off the income in the equities and go to a place where I have more guaranteed income. It actually makes sense.
I'll back up some of your numbers for you because I just read those reports as well. According to LIMRA, and that's the Life Insurance Reporting Organization, record-breaking sales in annuity 2 years in a row. 2022 and coming up with the final numbers of 2023, record-breaking numbers. People going into fixed numbers now. You're not saying that's the tool. When you were saying you don't know what tool because you need to know what project you're putting together, it made me start to think of one of those large hardware stores, right?
Right.
You know, ones with hundreds of aisles in them. And if you just walked up to an associate in one of the orange or blue vests, I'll go for both stores there, and you said, I need a tool to help me build something. You say, okay, well, you would ask as the finance, what are you trying to build? And if somebody says, well, I don't know, I just need a tool. You can't suggest an investment to someone unless you know what the project is, unless you know what they're going to build, right?
That's right.
All right, so when somebody says, I want an annuity, or, is my investment too risky? What you're going to come back with is, what are we trying to, are we using this for income? Are we using this for growth? Are we using this for legacy? You need to determine what the money is doing first, right?
Yeah, it all depends on what the plan is telling us as well. How old is this person? Are they retired already? Are they not retired? Especially if they're not retired, they may be in an accumulation phase. Is an annuity right for them? Are they in a decumulation phase where now they're pulling money out of retirement? Are there generational wealth transfers that we might want to be planning for? Or are we factoring in long-term care events, right? What are we doing to protect the risk of the portfolio? I mean, there's like an endless amount of variables that go into a plan that can affect the actual placement of those investments.
But also, like, if I were to walk into one of those big stores like that and go, I don't know what tool I need, because I don't know what I'm trying to build. I just know that I need the house, but I don't know how to build it. Do you get that as well? Like, I don't know what I'm supposed to be doing. I just don't want to run out of my money.
Yeah, and I actually think that's why people don't come in the office, right? They're like, I don't even know what to do. I don't know what to say. I'm not really sure, what the whole process looks like. And so when you go through the financial planning process, what we're trying to do is ask you, what does your lifestyle look like? What are you trying to maintain? What do you want it to look like in another 5, 10, and 20 years? How much money do you spend on an annual basis? And again, this shouldn't be overwhelming. It's just a conversation. And sometimes there's a lot of people that just want to get this off of their shoulders. So again, when we put them through the process, they understand it and they actually get more into it. There's some times where we have a couple come in and there's one of the persons like sloping down, sitting in the chair, and I'm like, oh, this isn't going to be very fun. But all of a sudden, 15 to 20 minutes into it, they're actually coming more up into the conference room table and they start asking questions. That's when I know that they're actually interested in this. So again, nothing has to do with a sales pitch. We're really literally trying to put you in a better position.
Yeah. In fact, we say this all the time. You leave your checkbook at home, leave your wallet at home. This is a conversation. This is seeing what kind of tool, what exactly first do you want to build? Then maybe we'll discuss some of the tools, and then we'll probably send you home as well and come back and think about it, talk about it again. Start your process. Get your own personal financial blueprint, and you can do that right here, whether it's us or someone like us. Just make sure that you're getting started. It is complicated. We know there's a lot of market volatility, but you can do that here with Eric Kearney and Joseph Lanza. Call 800-779-1942. What that's going to do is that's going to go to our secure call center. We'll set up an appointment for you. There's nothing to sell. There's nothing to pitch. It's a conversation finding out about what you want to do in retirement. So more retirement talk and market volatility when we come back right after this.
What does your retirement look like? Is it filled with travel, spending time with family, uninterrupted rounds at the golf course? Or are you too worried to even think about your hopes and dreams? Eric and his team can answer your questions with a complimentary review of your retirement and income plan, and it all starts with getting to know you. They'll do exactly that by going over your current strategy to expose the weaknesses that may exist in your retirement portfolio. Plus, they'll explain potential risks and possible strategies to you in easy-to-understand terms and help get you reacquainted with your portfolio and income strategy. Once they understand your retirement goals, objectives, and dreams, they'll work to custom build a retirement plan to help ensure that you cannot outlive your income in retirement. Because every dream needs a plan. Call Eric today and schedule your visit. You only retire once, so let's get it right the first time.
Welcome back to Retirement Talk with Eric Kearney and Joseph Lanza of Retirement Wealth Advisors. We are broadcasting here in the morning, so everybody take a sip of your coffee because we're talking about market volatility right now. Well, look at these nice mugs here. You can get one of these when you come in the office too, right? That's right. All right, guys, let's keep going here with market volatility. You hear this all the time. Just hold on, don't worry, don't change your portfolio, it will recover. Ooh, the one phrase I never like is, it's just a paper loss. Don't worry about it yet. But how about this? Is there a time to react to the market? Is there a time to change your portfolio? How are you watching what's going on in the markets? Do we always just leave it alone?
No, not at all. I mean, again, 5 years ago, we sent out a video to our clients and it said, look, interest rates are super low. Sooner or later, they're going to come up, and there's ramifications that come with that. Enjoy your low mortgage interest rates because it's not going to last forever. And boy, is that true. So what happens is that you have to have an advisor that has the ability to forecast what's coming down the pike. It's not always perfect, but it's better to be proactive rather than reactive. And a lot of times we're in the middle of a market meltdown, market volatility. That's when people want to take action. The problem is that you should have taken action prior to that. So I think in the past few years, we've done a really good job at hedging against volatility and also these multiple pullbacks and corrections. So again, you have to have the power to have the portfolio to fight another day. And that's really what we're looking for. And again, that's why we have a portfolio management team, a wealth management side, and also a financial planning side, because each individual has their own jobs to do to cover all those bases for that client.
Yeah, there's this great study. It was done on soccer goalie kicks, and they wanted to study, is there a percentage of where people go more often? My point on it is that 94% of the time they would stop more kicks if they just stood in the middle and did nothing at all. But come on, imagine 100,000 people in a soccer stadium. They either jump left or they jump right, and most of the time they miss it, right? Because they're trying. It's kind of the same thing with the markets.
Yeah.
You can't just constantly be saying we're not doing anything, but you are actually doing something. There's something about the portfolios of rebalancing. Maybe you can explain that for us.
Right, and it's a matter of not overreacting, but not underreacting as well. You don't want to ever overreact during a market correction, completely sell out of the market. Now you're in cash and you're saying, well, when am I going to get back in? But you also don't want to just set it and forget it and never change your portfolio. And I met with somebody not too long ago and they brought their statement in and I was going through it. Could actually see the purchase dates of everything in there. And it looked like a pretty outdated portfolio. And when I started looking at those purchase dates, that's exactly what it was, right? A lot of those things were purchased in 2016, 2017, and no rebalancing was ever done and nothing was ever added or decreased from the portfolio. It was the exact same. And it's no longer working for them. The market environment has changed. We know it's going to happen, right? The stock market today is not going to be the same as it is going to be in 5 years. Things are going to change, and our portfolios have to reflect that, whether it's economic data, fundamental data, technical analysis. We're constantly going through those portfolios and making sure everything is still aligning with our clients' goals.
Eric, it's not a high-level word. We understand the word rebalancing, but can you maybe give us some color on what rebalancing means to a portfolio and how it's done?
Yeah, sure. So when you have a portfolio and you get overweight or you made a lot of money in one asset class, we don't want to keep hanging on to that. Remember, what goes up must eventually come down. And so when something does go up, what we're doing is some of the profits at the very top, we're actually taking those off the top and then putting them and buying another asset class, maybe at a lower price. And what we're also doing is that we're looking at the correlation of your portfolio. Again, you've got positive correlation, which is not good. It means that you have asset classes moving up and down at the same time, What we're really looking for is negative correlation. When some things are up, some things are down, and that's okay, because sooner or later, what we're going to do is rebalance off the top and buy more shares at the bottom, because sooner or later they're going to go like this. And so again, I don't want to get too technical, but the bottom line is that we are active money managers, and that's what people are looking for. You know, a lot of these, you see these bigger firms, I think that a lot of these portfolios are parking lots for their money. They're literally, they bought something, it's sitting in there, but it's not being managed, it's not being monitored, it's not being maintained, it's not tied to a financial plan, it's not tied to an income plan, and certainly with inflation through the roof as of lately, it's not being considered. So there's a lot of things that people are coming into our firm and realizing we're not getting all this stuff at this other place.
But it's not speculative buying and selling. It's keeping things in balance. And from what I understand, the way that your firm works is the rebalancing is part of the portfolio. It's part of what you do. There's not like extra costs to doing rebalancing. This is how you monitor their portfolio, and that's what you do.
Correct. It's just, I mean, that is all within the costs. And that's the greatest thing about our firm, is that we are a fee-based planning firm. So we're charging a fee for assets under management. But there's two different people that come in. All right, Eric, number one, what's your fee? I'm paying a fee over here. What's your fee? Is it higher or lower, right? That's the first client. The second type of client that's going to come in is say, okay, Eric, I know I'm going to pay you a fee. What value are you going to provide me? That's the client that we want.
You know what? I'm so glad you said that. And it's not on our script notes here, so I love going off on this. What are you getting for what you're paying for? Look, if you say, what am I getting for a meal, and it's fast food quality, you're gonna be like, well, that, you know, maybe that's what you were looking for. But if you were looking for something that was fulfilling, that was healthy, and you were paying for it at, you know, at fast food prices, you're like, well, that wasn't very good. What am I getting for? What are the services? What about the communication? Let's talk about communication during volatility. You've got to have people who are worried when things are going up and down. Do you mind the phone call? Do you mind them writing you the email and saying, what's going on with the markets? How are we doing?
I mean, that's part of our service, right, is communication. It's all a part of the whole process of working with a financial advisor, or it should be. And we've said before on other shows, one of the biggest red flags of working with an advisor is somebody who constantly ducks your phone calls or you can't hear back from, right? I mean, imagine the market going through a volatile time and you can't even hear from your advisor to get an explanation of what's going on with your portfolio. So no, we don't mind those phone calls or emails at all. We fully expect them and we're prepared for them. Or Eric's putting out videos. The firm's actually educating ahead of time too. Hey, here's the things that we expect to see. Here's what's happening in the portfolios. That's an ongoing relationship with an advisor, and that's what we strive to have with every single one of our clients.
So before we go out to break, I'm going to give you the personal cell phone numbers of Eric and Joseph. No, but you can, of course, call the phone number you see down on the bottom of the screen. And when you come in, we do want you to be in communication with us. In fact, I think you often say that as well.
Yeah.
Anytime that something changes in your life, there's a worry, a concern with a dollar sign, give us a call. I mean, that's what your financial advisor is there for you. And what is the value that you're getting from it? Do you feel that they're only talking to you about investments, or are they only calling you when they want to buy or sell something? Or are they contacting you and saying, let us know when something changes in your life. Let us know how we can help you. Let us know if you want to talk about Social Security or taxes or your health care. That's what a true financial advisor can do for you. Get your own personal financial blueprint. You can do that here with the team. Call the phone number you see below, 800-779-1942. That phone call is going to go over to a secure call center, and we'll set up an appointment for you so you can come in and talk to the team. Maybe they will give you their cell phone numbers. But at least I know this. We'll get you started on your own personal financial blueprint. More retirement talk with Eric Kearney and Joseph Lanza right after this.
Retirement Wealth Advisors with Eric Kearney.
Are you overwhelmed by recessions, elections, and corrections? Believe me, I get it. And on top of that, who's more frustrated with the financial industry, me or you? If you're in a financial no man's land, give us a call today. Let's get that conversation started.
Retirement Wealth Advisors.
Welcome back. We are talking about volatility in the markets, and more importantly, what do you do about it in your portfolio? We talk about the retirement red zone. It's kind of that 2, 3, 4, 5 years before retirement, or maybe those first 2 or 3 or 4 years in retirement. This is a critical time for our portfolio. Eric, what do you do then to mitigate risk during these retirement red zone years. Is this getting it out of the market? Is this rebalancing down to those kind of funds that, you know, we can count on a little more consistently, lower target date funds? It's really confusing today. Where do you go?
Yeah, so I mean, and again, I mean, everybody's different. You know, that's the interesting thing when it really comes to financial planning. Everyone that walks through the front door, it's a different situation. And everybody also has different risk tolerances. They have different income needs. Some people have a pension, some people don't have a pension. Some people want to continue to work in retirement. Some people are getting a large inheritance. Some people have a lot of real estate to sell. The bottom line is that there is no cookie cutter process here. Everybody that comes in, we're really looking at their personal situation and saying, okay, what do you need long term? And again, purpose, the purpose of their life, the purpose of their money, then determines placement. And so again, we've got to take in, as a fiduciary, we by license and law, we have to look out for their best interest, which all of us at the firm take very seriously. So what we're trying to do is sit down with a client, seeing what they're trying to accomplish, and then give them options. And here's the nice thing about that. We're not telling you what to invest in. We're actually saying, do you like this option, or this option? Because a lot of times people want to be very involved. Now that they're doing financial planning, they're all in. So they want to start to be able to pick and choose their own investments. And as long as we give them a couple different good options, I think that's a good thing.
Something I had pulled off a blog recently, which I thought would be an interesting question to ask right here, is, are people relying too much on the media to make financial decisions? Now, of course, we're in a television program here.
Yeah, we are the media.
But you're licensed in a certain way, and you can't give investment advice. You're specifically licensed that we can't say that this is the best option, this isn't. Mm-hmm. You need to know people personally. It's the suitability requirements. But do you think the media is pushing people into, I'll say the word crypto, all right? Let's say people want to ride the crypto fad, and you're watching these things go up and down. Should we be looking at the media for our investment choices, especially when it comes to retirement choices?
No, not at all. You know what drives me crazy about the media is that when the markets plummet or they pull back, which they do, it's normal. It's actually a correction or a pullback is actually healthy for the market long term. But what happens, Spike, is that all of a sudden when things go bad, all of a sudden the gold bugs come up. You got to buy gold, and then all these washed up commercials come up, and all these washed up actors come up, and they're like, you need to really have gold. I have gold in my account. I don't have gold. I will probably never will own gold. I just don't get gold, right? It does not pay a dividend. It's only worth what it's worth. And really, I mean, I think that there's a lot more risk compared to the reward that you get for it. But the bottom line is that when we really take a look at this, you're trying to build a pragmatic plan. And it's very difficult when you have all this volatility. But when you really take a look at the news, here's the one thing that you have to understand. When you watch your local news, they're talking about the temperature of the beach. They're talking about pickleball tournaments. It's not really that exciting. It's pretty actually boring. Hey, by the way, a new restaurant opened. You should try it. They got conch fritters. So the bottom line is that our local news is pretty boring. Now all of a sudden you go out to the statewide and there's more stuff that's going on. This person was kidnapped and so forth. Now all of a sudden you go out to the United States level, it's pretty big, and then you go out to the international. So what the news wants is they want to find all these horrible things that are happening around the world. But you have an entire world to choose them from. And the news media is reeling us in, and they know how to keep us there. And my mom is just as much to blame. When I pull in her driveway, I can hear the news from inside my car.
I know what you mean.
Yeah. So, but you know, it's constant turmoil, and that's what they want to hear. And it is not good for our mental health. It is something like, I do not have the TV when I go home. You know, I go home the other night and they're like, my neighbor says, hey, Eric, how'd the market do today? I'm like, I have no idea. He goes, shouldn't you know? And look, we're not day traders, right? We're looking at, you know, long-term trading. I eventually will know what the market did, right? The bottom line is that I'm not going to pay attention to it constantly because, again, for my mental health reasons, I look at it, I'm constantly looking at it. But for us looking at the news, we really have to start divorcing that.
We're talking about our own mental health and mental health through retirement. It used to be that we would get our news drips maybe once or twice a day, right?
Yeah.
You'd either watch the evening news, maybe you were watching some of the morning shows as you were getting ready for work. This constant bombardment with the news and what Eric was saying, the negative news.
Yeah.
It's, we know that this is what's going to make somebody click on this article or pay more attention.
Right.
It is not helping you. So when it comes to your portfolio, and I know this because I have come from the broadcast world. You two, as licensed financial advisors, we're taught where to get the news from, where to get the information, but we're not told what to do with it. And that's where you two are connecting the dots. It's like, okay, you saw that in the news cycle. This new election is coming up. The bond market did this. Right. But do you have a financial plan in place? Okay, that we're okay. We're set with our drawdown. Does the financial plan for you help people stay away from all this news?
For sure. I actually had a phone call with a client just the other day, and they were saying, hey, before we hang up, I saw this article about the following year coming along, and this person thinks it's going to go down. What are your thoughts on that? And I answered the question. I followed up with, to be honest with you, sir, I could find you 10 articles on why the market is going to be the best it's ever going to be next year, and then I can find you 10 articles on why we're going to have the worst crash ever next year. And with social media now and the internet, it's made it 10 times worse. It's just like what you said. They want you to click on something. What's the most dramatic headline they can get you to click on? And we're seeing it more than ever right now.
So you were hinting towards it, and as we wrap this up, I want to see if I can pull all these strings together. Is there something positive we can do with market volatility? Rather than just being scared of it or hearing the negative or watching the red numbers on the chyrons on the bottom, can market volatility be positive in some way?
100%. I mean, when the markets keep going up, as a money manager, I'm looking at them and saying there's not a lot of opportunity. But all of a sudden, when they correct, they get volatile, they pull back, now all of a sudden, I can layer in new positions for a client that have been wanting to do that. So just like you're dollar cost averaging out, you could also be dollar cost averaging into the market. So you want to understand, are you working with a real investment advisor who understands money management? And the one thing that I will say really quick, Spike, is people don't understand just because you're a licensed financial advisor doesn't mean you know how to manage money. And so you really want to know who actually has my hands on my portfolio. That is super important.
Right. And it's not just yourself, it's the team. You've got the portfolio team. Right. You also have your tax professionals. You also have your background in doing estate planning for folks and helping them with that, although not, of course, licensed estate planning attorneys. But it's really going back to that bigger part of the conversation in the middle. What value are you getting for what you can do for folks? We've got on the bottom of the screen here right now our Chiron. It's not red. It's not because the markets have gone down. It's our portfolio recovery review. What is that? We only have about 30 seconds.
So really quick, if you're out there and you feel like something is not right with your portfolio, give us a call today. Let's do a full portfolio recovery strategy. Let's see what's going on with your portfolio. Let's see how we can make improvements. We look forward to seeing you soon.
Eric and Joseph, thank you guys so very much. Yeah, there's a lot of negativity in the news, but pay attention to you and your family. Get your portfolio recovery review. Call the phone number down here. Thank you for watching. We'll be back next week.
Hey, Southwest Florida, thank you so much for watching today's show. If anything's resonated with you today, or you're really looking for that second opinion, give us a call today. If you're serious about your finances, we're serious about working with you.
Remember, you only retire once, so let's get it right the first time. Have a great week and an even better retirement.